hear this all the time. I'm invested in the S&P 500, so I'm globally diversified. That's not necessarily true. Your portfolio could have a lot of home bias risk. So today, we answer the question, should I invest internationally? Let's chop. Have you ever thought that having the S&P 500 in your investment portfolio considers you globally diversified? That's not necessarily the case. You could be having more risk in your portfolio than you think. So today we're going to chop it up about investing in international stocks or indexes. Hi, I'm Dr. Preston Cherry, founder and CEO of Concurrent Wealth Management, where we help you align your life and money to help you live your wealth your way. And as always, if you like what you see, hear, and feel on the show, please hit that like and subscribe button and share with your family, friends, and colleagues. All right, let's chop. Is the S&P 500 deceptive or diversified? Well, if you have the S&P 500 in your portfolio, you could be tech heavy because in the S&P 500, there's 500 companies, right? That seems diversified. And also there's 500 U.S. companies that have international exposure, gaining some of their revenues from outside of the country and all over the globe, right? Well, the S&P 500 index is tilted strongly to the tech sector. So you've heard of the Magnificent Seven. That includes Google, Amazon, Meta, NVIDIA, right? And a few others. And these type of large tech growth companies consume about 35% of the S&P 500 index. So considering large technology companies and a couple of others outside of that, you may be concentrated in the top 10 holdings or big tech anywhere between 28 and 35%. That means when these large top 10 holdings and considerably amount of growth tech swings up to the upside or the downside meaning the most pain, right? Then you're going to feel the movement of that 35% stock allocation to those companies. And sometimes that doesn't feel very well. The tech companies, particularly the growth ones, are a headline risk. So when things are not going right in the economy and outlook is not looking good, sentiment is not looking good, then, or they don't meet their earnings, or they're issuing guidance on their calls to the shareholders, then these top 10 holdings, and particularly the tech sector, tend to react swiftly to that news. So if you have the S&P 500, then 35% of your portfolio is susceptible to these volatile swings because of the concentration in the growth tech sector. Now, that may feel good during upswings in the market and large rallies. That said, on the other side, when there is large downturns to the other side, then that concentration is not going to feel so well. And also, folks tend to double down on their individual stock investing to even further increase their concentration risk to the tech industry. So you may want to consider investing internationally, which the S&P 500 does not have any direct international stock exposure in the index across the 500 companies. And we're going to talk about what getting international exposure means in a couple of segments. Now, that's a good pivot to see when the international stock market has ever beat the U.S. stock market. And it's not about beating, it's about having a diversified portfolio to where some areas of your portfolio are performing well, or all are performing well at the same time, or some are performing well and some are not. And it smooths out the returns and risk of your portfolio. That's what diversified investing is all about. Now, between 2000 and 2009 is considered the lost decade for a U.S. invested portfolio because the returns on a 60-40 portfolio during that time, and even the just U.S. stock market, it was returning a flat return for that decade. Now, if you had some exposure to international during that time, then your portfolio did better. Now let's take a look at the indexes for the international during that lost decade. Now you have two indexes, one that represents large international companies and then another for smaller ones. So you have the MSCI Europe, Asia, Far East, so EAFE, and then you have the MSCI Emerging Markets Index, right? And for the EAFE, the returns for that year were 1.17. So the S&P 500 was down almost 1%, and the large international index was up 1%. Now you have the emerging market index that was up around 9%, almost a 9.5% during that time. The exact number is 9.78. So as you can see that during the lost decade, if you had an exposure to the international stocks, both large companies and the emerging market, your portfolio would have performed better during the lost decade. Now, there was a study from Russell Investments that looked at rolling 10-year periods from 1970 to 1923, and it showed that 45% of those 10-year periods, rolling 10-year periods, if you had a portfolio that had both the S&P 500 and exposure to international, 45% of those 10-year periods performed better than just an S&P 500. So having that international, globally diversified portfolio helps you perform well when the U.S. may be doing well or not so well or not well at all. And you have that international exposure to either balance out because the international is doing better or both of them are doing better at the same time. Now, knowing this information, a lot of folks ask, well, how much should I allocate in my globally diversified portfolio to international stocks or indexes? Well, it depends on your risk profile and capacity. Now, generally, a mix between 20 and 30% exposure to international markets within your equity sleeve of your portfolio fits most people, again, depending on your own capacity and risk profile. And then you have to have a mix between the large developed international and also those emerging international. Now, global diversification doesn't always feel good because when you have positive performing years in the S&P 500 and particularly those outlier performing years like 2023, where you had 26% return during that year. So people ask, well, why should I invest in international stocks and just stick with the S&P? And the S&P 500 has performed very well the last 10 years. And folks was like, well, the international exposure is being a drag on my portfolio. Well, you have returns and then you also have volatility. Volatility is the magnitude of the swings up and down, right? And you want to try to smooth that out over time and have your portfolio hopefully not only perform better over time, but also feel better with less volatile movements up and down and smooth out the ride a little bit. Nobody likes a shaky ride on a roller coaster, right? That said, having a globally diversified portfolio tends to lower that volatility shakiness, right, by 15% on average. Also, during U.S. recessions, those globally diversified portfolios tend to experience less of a drawdown because of the 100% exposure to the S&P 500 and the U.S. economy. Now, everybody has an affinity for their home place, right? You have your birthplace, your home place, right? It feels good, right? So that's the same thing in stock portfolios. Many folks suffer from a behavioral finance mentality or mindset of home bias because it's familiar and that's what people invest in. I encourage to step out of the home bias mindset and consider a globally diversified portfolio because of the aspects that we just mentioned, right? Lower volatility and potential when one economy is doing well and the other one is not, or both at the same time, you might have a better portfolio over time. Lastly, I'll say here that folks like to say, well, again, if the S&P is doing so strongly, why invest to international portfolios? That doesn't preclude you from pivoting from either or in rebalancing. I think what's prudent here is looking at your portfolio annually and having a domestic and an international allocation, and looking at that allocation and seeing how it's aligning with your goals and your risk profile and your capacity, and perhaps take a little off the table or add a little bit on as far as international and US according to what your annually reviewed goals are, and still have that globally diversified portfolio. Now, let's round out the show. Being invested in the S&P 500 is not the same as being internationally diversified. When you are invested in the S&P 500, yes, they get some of their revenues from companies internationally. That said, the international direct exposure has exposure directly to different type of policy, business policy, government policy, consumer attitudes, and the like. So you have direct exposure when you're investing internationally to the economic and governmental and business engines of that country, whether it be internationally developed in the EAFE or the emerging markets. And remember, EAFE is Europe, Asia, Far East. And on top of all that, you also have the exposure to the currency diversification, which is lacking in the S&P 500. So when you have a mix of exposures to consumer, business, policy, and currency diversification, this is why you get direct access when you are investing internationally. All right, here's another reason to invest internationally. Different countries specialize in different areas, so sectors, right? So I mentioned already that the U.S. is dominated with the tech sector, and the S&P 500 consumes anywhere between 28 and 35% of the S&P 500. So when you have the S&P 500, it's tech heavy. When you invest in other international countries, they may have stronger sectors in manufacturing, agriculture, financials, and many other sectors that the U.S. doesn't necessarily specialize in. And this is why direct investing in international helps mightily diversify the sectors that you are exposed to in your portfolio. And lastly, as we mentioned, no one wins forever, right? So when the U.S. has been on a tear for a while, and it looks like it will continue to grow at a nice pace, perhaps slower, right? You have other countries that are growing at a rapid pace, and their markets and their sectors are doing well along with their consumers. They have different consumer makeup than the U.S. does, right? So you have these economies that are thriving at a higher pace, perhaps, than the U.S., and having exposure to both of those economies and currencies and business sectors and political and business risk, right? Those are what's going to bring the magic to your portfolio over a long period of time, 10, 20, 30 years, right? And you can also, as we always do at Concurrent Wealth Management, for those folks that want to have a little bit more concentration risk in their stock picking, or they're having exposure to their equity compensation, their company that they're working for, and you can take the cash on hand and say, okay, those markets and sectors that interest me, the countries that interest me, those tech stocks or energy stocks around the globe or whatever, then you can take that extra cash and have that invested in your satellite portfolio along with or alongside your core internationally invested portfolio. All right, that's what I got for you. If you want more, even more detail, check out the Concurrent Wealth Management blog. Jump on over to the site and check that out for some good reading. All right. Love chopping it up with you. That's what we got for the week. If you like what you see, hear, and feel on this show, please like and subscribe, share with your friends, family, and colleagues. And until next time, we'll chop soon. Cheers.